Properly written books of accounts is the basis on which financial statements are made. A look at the client's financial statements for the previous year will give you an idea on the nature of their business and their routine transactions. A P&L accounts for a business's revenues and expenditures. The most dominant source of revenue is the sales revenue, and purchase is a major expense. Sales and purchases are evidenced through invoices. We may have already received these invoices from the clients when they file their GST return. Form 26AS, which reflects against their PAN, will also give you an idea on their revenues. If the client does not file their GST returns, then make sure to have copies of their bill books, debit notes, credit notes to get an idea on the volume of sales and purchases. Information that you get from the client for filing their TDS returns or the details provided by them for professional tax will give you an idea on the salaries, commission, and other professional fees paid by them. Then there are bills and vouchers that show expenses like electricity, telephone, travel, and conveyance. The next step is to reconcile all these bills, invoices, and documentary evidences against the client's bank statements. You must distinctly identify the odd items and post it as a part of a temporary suspense account. For example, it is possible that a payment reflecting in bank is a loan provided to a relative. Maybe some payments are made to meet a personal expense of a director or a partner. There could be investment made in mutual fund or shares for which we do not have proofs. There could be a fixed amount being debited from the bank each month. Perhaps these could be installments for a loan which was taken. There could be expenses incurred this year which pertains to the previous year, or an expense paid in advance. You must not make any assumptions or confuse them as routine transactions. Instead, you must get an item-wise clarification from the client on every entry you made in the suspense account. Sometimes there could be items which neither reflect in the documents nor in the bank transactions. For example, sales and purchases made in the last month of the year, invoices for which are yet to be raised. There could be revenues and expenses accrued but not paid during the month. If there are any loans given or taken, then you need to determine the interest rate and provide for accrued interest on them. There could be transactions made in cash. You must get a confirmation on the type and volume of such transactions. You must be proactive in gauging these transactions and getting information about them by listing all of them and asking specific questions on each. Let's now move towards the balance sheet. The closing balances for all the items of assets and liabilities in the previous year is carried forward as opening balances for the current year. In an unlikely scenario where there is a discrepancy here, it must be highlighted. Usually, receipts and payments made during the initial months may be towards the sundry debtors and creditors reflecting in the opening balance. However, you must check if the sundry debtors and creditors include outstanding balances that are overdue. In that case, you must determine if you need to make a provision for doubtful debt or write off a debt altogether. You must also clarify if there are any changes in the long-term items, like additional capital infused in business, repayment of a loan, procuring additional loan, making a new investment or redemption of an existing investment, acquiring a new asset, selling off an existing asset, and so on. You may discover these while scrutinizing the bank statements. Nevertheless, it helps to get a documentary evidence for these transactions as well. In this manner, you must verify transactions and items for clients depending upon their nature of business and type of transactions. When information is compiled item-wise, transactions are recorded meticulously and reconciliations are performed thoroughly is when your financial statements will reflect a true and fair view of the state of affairs in your client's business.